Hey, welcome back. It's Jason Walter here. Even with extremely low mortgage interest rates, real estate is becoming more and more unaffordable. This is one reason why a growing share of consumers believe it's a bad time to buy a house right now. But for those of you who follow the channel, you know that home prices have decreased over the past 2 months, and this is according to the latest data that we have from the National Association of Realtors, or NAR. Does this recent dip of home prices mean that it's becoming more affordable to buy a house? That is the topic of today's video. I'm also going to give you an update regarding mortgage interest rates because those have been skyrocketing lately. And before we dive in, just a friendly reminder, if you're looking for a real estate agent referral from virtually anywhere in the US, then check out homeandmoney.com/Jason. All right, with that said, let's begin today's video, starting with a recent survey that was just posted by Fannie Mae. They found that an increasing share of consumers believe it's a bad time to buy a house, while the majority believe it's a good time to sell. In this report from Fannie Mae, they announced that 66% of consumers reported that it's a bad time to buy a house, up from 63% last month. This is significantly higher than the 28% of respondents who believe it's a good time to buy. In contrast, a strong majority of consumers maintain that it's a good time to sell a house. The percentage of consumers who said it's a good time to sell a house increased to 74%, while the percentage who said it's a bad time to sell a house remained unchanged at only 19%. Two of the main reasons why home buyers are becoming more and more pessimistic about home buying right now is due to high home prices and, of course, historically low amount of housing inventory despite a recent increase this year. But the median sold price in the US decreased recently. So what effect does this have on housing affordability? According to the most recent survey from NAR, affordability improved in July as the average monthly mortgage payment fell by 2.2% and the median family income rose by 2.3%. However, compared to 1 year ago, affordability declined in July as the median family income only rose by 2.3%, while the monthly mortgage payment surged by 16%. So have a look at this. The current index sits at 150.4, which is up slightly from June. What this means is that housing affordability improved slightly from the previous month. This is due, of course, to a slight dip in mortgage rates and also home prices. But besides June's reading of 146.5, the index hasn't dipped below 151 in over a year. And please keep this in mind, the higher the index is, the more affordable the housing payment is going to be. So how is this all compared to prior years, right? So we want to look at 2020, but also more importantly, 2018 and 2019. The average housing affordability index in 2019 to 2020 was higher compared to April to July of 2021. This means that housing was technically more affordable in 2019 to 2020 on average compared to now. The reason for this was because home prices were much less in the prior years. So check this out. In 2020, the median home price averaged $300,000, and in 2019, it was only $274,600. In contrast, home prices have shot up to $367,000 in July of 2021. And here's a key point for you guys. Take a look at the average mortgage interest rate. In 2019, the average interest rate was 4.04%, and it dropped to 3.17% last year. In July of this year, the average mortgage rate decreased to 2.92%. So even though mortgage interest rates dropped greatly, it's still more expensive to buy a house because home prices increase significantly. This is exactly why I tell people not to just buy a house simply because mortgage interest rates are so low. This is because when mortgage interest rates decrease, that increases home buyer demand, which pushes up and elevates home prices. In addition, higher home prices, of course, make it less affordable to buy a house, especially because wage growth has not increased at the same levels as home price appreciation. And of course, the big question is, how much more expensive is it to buy a house? And here is the answer. Compared to January of this year, the average mortgage payment rose from $1,011 per month to $1,225. By my math, that's an increase of $214 a month and over a 20% gain in just 7 months. Looking ahead into the next couple of months, I would imagine that housing affordability is going to get worse because mortgage interest rates have skyrocketed. So check this out. Rates more or less bottomed out on August 3rd when the average 30-year fixed rate mortgage was 2.78% on average. 2 months later, rates have skyrocketed to above 3%. This recent increase has caused mortgage application numbers to hit a 3-month low. According to a new report from the Mortgage Bankers Association, or the MBA, total mortgage applications decreased 6.9% from 1 week earlier. Be very cautious though when you're reading news headlines, because what does this dip of mortgage applications, what does this really mean? Okay, so this is super important. The total number of mortgage applications that people are submitting comes from 2 main sources. Number 1, of course, would be from homeowners who are doing a refinance of their mortgage. And number 2, of course, would come from home buyers looking to purchase a house. So overall, total mortgage applications dipped by almost 7%. But let me break this down for you because, of course, this comprises of refis and also home purchases. According to the Mortgage Bankers Association, the refinance index decreased 10% from the previous week. However, the unadjusted purchase index decreased by only 2%. Therefore, the decrease in overall activity mainly came from a big drop of refis. This, of course, makes sense because mortgage interest rates skyrocketed last week. Joel Kahn of the MBA stated the following: mortgage applications to refinance dropped almost 10% last week to its lowest level in 3 months, as a 30-year fixed-rate mortgage increased to 3.14%, the highest since July. Higher rates are reducing borrowers' incentive to refi, as declines were seen across all loan types. In addition, the refinance share of mortgage applications was 64.5% of total applications. Therefore, only 35.5% were from home purchases. Also, it could be possible in the coming months that the total number of people who are applying for mortgages may continue to decrease in the coming months. And this is, of course, because the U.S. Treasury yield, or the 10-year U.S. Treasury yield, has been increasing lately. So for example, at the time of this video, the yield on the 10-year US Treasury note surpassed 1.5%. This is the highest level since June. And by the way, if you're a home buyer, then check out this video right here, because in that video, I discussed all the challenges that home builders are facing right now, which of course is affecting the amount of new houses for sale. If you got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that, and also consider subscribing.